Well, let's talk about Chapter 10, Protecting Your Property. So this is about property and casualty insurance. So moving on from health insurance now to property and casualty insurance. So you can see what the various goals are we'll talk about here in Chapter 10. How will this affect you? If you buy big things that are expensive, like a home and a car, they better be insured, right? So that's really what we're talking about is, again, I keep bringing this up. The point of insurance is to transfer risk. From the risk of something being damaged, stolen, lost. You're transferring that risk so that you don't have to pay for that. You're transferring that to the insurance company. So you're minimizing risk and moving that exposure. Now, if you have a loan on something, your home or your auto, the bank will require that you have insurance. And of course, if you have a vehicle, there's a minimum amount of insurance you have to have through law. You have to have a vehicle insured. So those are things that you just need to be aware of so you can make good decisions about insurance as you go out and look at the policies you want to buy and so on. So as always, you can look at the financial facts and fantasies on your own. So some basic principles of property insurance. Okay, so property insurance is simply coverage that protects real and personal property from some kind of loss, and some kind of peril, whatever that is, fire, theft, vandalism, windstorms, hail. It depends. Not everything's covered necessarily, but a lot of the common type things are. Liability insurance provides protection against financial consequences that arise from the insured's responsibility for property loss or personal injuries to others. So, if you have a vehicle, you have to have at a minimum have liability insurance. So what that means is you're driving and you cause an accident and you injure somebody else or damage their property, like their vehicle, that your liability insurance would make them whole. Now that would not cover your personal vehicle. If you only had liability insurance, your vehicle, you have to pay for that on your own, but you've now at least you can cover the loss of the people that you were a part of the accident with. So there's always some key principles, just like there was with health insurance. Let's talk about types of exposure, indemnity, and coinsurance. So types of exposure, property loss, just that economic loss due to property being damaged, destroyed, or stolen. 2, obligations of property owners to develop a complete inventory of your property. Exhibit 10.1 from your book will kind of walk you through how to do that. There is not a worksheet for this chapter, by the way, so just so you know, there's no Excel worksheet provided by the author for this chapter, so you're kind of on your own. But Exhibit 10.1 is a good example. A best practice that I've had people in insurance tell me is video your home. Just go room to room and video everything in each room. So just pull out your smartphone or your tablet computer and video everything that you own. Anything that you would want covered in terms of electronics, jewelry, antiques, anything that if there's a fire, if there's a windstorm, tornado, theft, that will then be covered by the loss that you are incurring. Upload that video to the cloud, essentially, right? Then now it's always available. So that would be a strong suggestion, just to do inventory. Just video or take pictures, upload them, and you now know what you lost. You can tell the insurance company, look at this. This is what I lost. Identity of perils is basically what kind of perils might you be covered for. Some will never be covered by insurance. You can see a couple of those: war, nuclear radiation, mudslides, mysterious disappearance, ordinary wear and tear, sewer and drain backups, unless you buy a policy specifically for that, or you add that on to your homeowner's policy, which is possible. Earthquake and flood insurance are typically only provided by the federal government because it's very expensive for private and companies to provide. But your standard policy would not include those things. If you want some of those things covered, you would have to go to your company and add those on, or go to the federal government and get some of the extra coverages. But war would never be covered, for example. Um, Liability, loss exposures from negligence, failing to act in a reasonable manner, or take necessary steps to protect others would be one possible liability exposure, negligence. Liability insurance coverage will protect you against losses resulting from these risks, including high legal fees of negligence. Liability may be covered through your homeowner, automobile, or separate what they call an umbrella policy. An umbrella policy is insurance that kind of covers a kind of a comprehensive look. So if you are negligent in something that you do outside of your homeowners or automobile policy, an umbrella policy may kick in. A lot of high wealth individuals will have some kind of an umbrella policy to protect them from getting sued quite often, just because if you got more money, more people might come after you and sue you potentially to get your money, and so an umbrella policy might help protect from some of those things. One key thing that says it in red because it's that important is you cannot profit from an insured loss. The whole goal of insurance is to make you whole, but not to make a profit. Okay, so what you get back is, depending on the coverage that you have, if you want to pay extra for your car insurance, your homeowners, you may get market value replacement, or sometimes you just get what you spent replacement. So depending on the type of coverage you have, so example for a vehicle, if you are driving a $20,000 vehicle, even though you spent more than that to buy it, it might only cover what it's worth today. It might not cover what you spent to initially buy it. Just depends on the policy, so you got to be careful about stuff like that. But again, the point is not to profit, it's just for you to become whole again. That's really the whole point of this type of insurance. So I kind of already mentioned that. Are you going with actual cash value versus replacement cost? Again, it kind of just depends on the policy that you choose, and of course you pay for extra coverage. Subrogation is after an insurance company pays a claim, it has now a right of subrogation. It allows it to request reimbursement from either the person who caused a loss or that person's insurance company. And so quite often, if you've ever been in a car accident, and typically there's the police are involved and will at least write up a report and speak to both parties involved or everybody involved. Depending on who they sign at fault, or if they even sign somebody at fault, that will then impact what insurance will potentially pay. Other insurance, like all property and casualty or property and liability insurance contracts, have other insurance clause prohibiting insured persons from insuring their property with two or more insurance companies and collecting multiple times for the same loss. So the whole point is, if you buy two auto policies, and maybe now you're thinking, I want to intentionally get into a wreck, so now I could submit a claim twice, right, to two companies and make money in that deal, right? So you can kind of see why that's not allowed. So that's not something that's good. So you're not allowed to do that. That'd be against some laws. Co-insurance just means that a policyholder is going to pay some percent of the loss. They'll cover that on their own. And again, how much the co-insurance is depends on the amount of coverage that you would choose when you buy a policy. So for example, it might be that if your home burns down, and depending on if you have an 80% policy, the insurance company will say we'll give you 80% of what that cost you. Okay, so the other 20% you got to come up with on your own. Homeowners insurance, you can see here there's 5 different forms, and Exhibit 10.2 of your book will walk you through these pretty good, so you want to make sure you take a look at that. And you can see what 1 through 1, 2, 3, 5, and 8 are the different types out there. Basically, it depends on what you are insuring. H4 is for renter's insurance only, so that just covers your personal items but not the actual property. Condominium coverage will be a little bit different, and so on. So it just depends on what level of coverage you want and if you're renting or what type of property you live in. So Section 1 of a homeowner's policy covers perils. Basically says what's covered and what isn't covered. Typically, flood and earthquakes would not be covered. You'd have to get coverage from the federal government if you want coverage for those. And then Section 2 perils covers the negligence of a person, excludes libel, slander, defamation of character, contractual or intentional wrongdoing. So depending on what your occupation is, you might, and your personal wealth, you may, buy those types of coverages or buy an umbrella policy that will cover some of those things. Just some things that affect the cost of homeowners insurance: the type of structure it is, if it's wood frame versus brick versus whatever. Your credit score actually will also come into play. Where the home is located, clearly some properties would have more exposure to risk than others. If you're in a forested area, right, you might pay more because a forest fire wouldn't happen. If you are in the country and far away from a fire station or fire hydrants or anything like that, you probably would be paying more. If you've got a fire hydrant right in front of your home or near your home, you probably wouldn't pay as much because it'd be easier for the fire to be put out. So those things come into play when the insurance company will underwrite you. So Section 1 then talks about the coverage for dwelling unit, anything attached like a garage, and also personal property. So if you have a homeowner's policy, that also includes a lot of your personal property. Some exclusions, though, would be business inventory, animals, motorized vehicles. You have to have separate coverages for those. So if you have a vehicle in your garage and your garage burns down, your homeowner's policy will cover your garage, but your auto policy would cover replacing your vehicle. Some businesses, such as computers and office furniture, may be covered up to $2,500. Again, just kind of depends. A personal property floater then basically is an insurance or endorsement policy that provides blanket or scheduled coverage for expensive personal items that are not adequately covered in a standard policy. So a recommendation I would give everybody is expensive jewelry. So if you're married and you have some expensive wedding ring, engagement ring, you should buy a specific policy just for those, because your homeowner's policy will not probably cover the cost of that by any means, so you probably would want to buy a separate policy for that. Renter's insurance, I've mentioned that before. If you are renting, you want renter's insurance. So if your property is damaged through a fire, wind damage, tornado, property is stolen, this will cover that. It does not insure the property. It insures your personal items at your property. Okay, so it's very inexpensive, definitely worth getting. 3 types of property-related losses is direct loss of property, indirect loss due to damage, or additional expenses resulting from the direct or indirect loss. And that's typically what is covered. Replacement cost is normally paid for a dwelling unit. That's limitations on payment. Replacement cost is the amount necessary to repair, build, or replace an asset at today's price. Full replacement cost will be paid only if the homeowner keeps their home insured for at least 80% of the amount that it would cost to build today. In personal property, in-house is typically covered for the actual cash value replacement cost, less depreciation. So if you don't want that depreciation to be taken away, you can pay extra typically. Deductibles and limits. When you buy homeowners insurance, when you buy auto insurance, they'll ask you what you want your deductible to be. Basically, how much you have to pay on your own before insurance coverage kicks in. It's really up to you. It's a matter of personal opinion about what that is. The higher the deductible, the lower the insurance, though. $1,000 is not necessarily that bad. I carry a $1,000 deductible on my home. I had roof damage, had to replace my roof. It cost me $1,000 to replace my roof, which was about a $6,000 deal, so not that bad. There are limits for certain categories of items, of course. Cash is limited to $200 because how do you prove cash was stolen? Deeds and passports, jewelry, personal liability, and you can buy higher limits. So again, if you have a wedding ring or some jewelry that's worth more than $1,000, I highly encourage you to add that coverage. It's not expensive to cover that. So let's talk about automobiles next. You can see here the 4 parts: liability, medical, uninsured motorist, and coverage for damage to your vehicle. And of course, not all this is required for you to buy, depending on what your circumstances are in terms of what your vehicle is worth, how much risk you want to take on your own. But there is a minimum. You have to have liability insurance. That is required. And if your vehicle is subject to a loan, I promise you the bank will require that you have insurance on your vehicle. So liability insurance typically required in most states, and you would be fined if you didn't have it. So if you're pulled over for any reason, police have the right to ask you for proof of insurance. If you don't have that, they can write you a ticket for that. Pays for bodily injury and property damage to others when you are responsible for the loss. So if you cause an accident and others are injured or property is damaged, this policy kicks in to make them whole again. Insurance companies may limit total damages paid for any one accident. Again, it's a matter of how much you want to be covered. You can see what the limits are there. Some insurers will split the limits of liability coverage available also. But it's kind of in their state minimums that are required, right? So depending on what state you live in, you might be a minimum you're required to carry. And of course, an insurance agent would know what that number is and sell you the proper policy. Part A is who and what is insured. The insured person is the name of the insured. That includes family members, any person using the auto with your permission. The key is they have to have your permission, and any person or organization responsible for the insured's actions. A covered auto is listed on the declaration page. So if you have never bought auto insurance on your own, if your parents have been buying it for you, whatever, just ask them or on your own if you have this. Take a look at the declaration page of that policy. It lists all kinds of stuff. It lists exact vehicles with their vehicle identification numbers that are covered under the policy. It'll list the family members who are covered on that policy also. So basically, if you buy a vehicle, you call your insurance company or your agent, you tell them you bought the vehicle. They'll add that to the declaration page, price that insurance for you, send you a notice, of what the new coverage is and so on. My policy includes rental, so if I go and rent a vehicle, I'm covered. I don't even have to tell them that I'm renting a vehicle. If you do that, if you rent a vehicle, just make sure that you have that proof of insurance with you. Just bring that with you so that if you are pulled over or get in an accident with that rental vehicle, you can show that I am covered. It doesn't hurt to call your insurance company though and just double check that. I would highly recommend that if you're not sure, just call your company and say, I'm going to be renting a vehicle. Is that covered under my current policy? And just make sure you find out for sure. Don't assume that you are. You want to double check that. Medical payments. So if there is an accident, it covers family members, the insured, and passengers in covered autos. And so covers injuries sustained by a pedestrian or while riding a bicycle. So it just covers medical issues regarding any accidents. Uninsured motorist pays if somebody hits you and they're not insured, or there's a hit and run, so all you're left with is your vehicle's been damaged. I had my sister-in-law, or my sister I should say, just their family vehicle or one of their vehicles is parked in the street, and somebody in the night sideswiped it and knocked the mirror off and damaged the door. It all works fine, but it looks bad. So that would be an example of a hit and run. All you can do is call the police and file a report, but now you're stuck covering that on your own. So if you've got uninsured coverage, at least the insurance company will pay for a portion of that. So anyway, so you can see what's kind of some of the requirements are to get that kicked in. Another driver is at fault. That person was either uninsured or underinsured, and damages were incurred. Part D is physical damage to the vehicle. That's collision. So you're in an accident and you want to get your car fixed. Doesn't matter who was at fault, if it was you or somebody else. Basically required for financed cars to protect the investments. So if you have a bank loan on your car, the bank will definitely say you must carry collision coverage, because that's the way the bank protects themselves. If your vehicle that they are lent you money to buy, if that vehicle is now damaged, insurance will now kick in to put the car back together again. Part D is comprehensive. It covers loss for other perils other than collision, so hail, fire, theft, falling objects, a tree that falls on your car, and so on. Of course, the collision would also cover hitting a deer, which is pretty common where we live. No fault insurance depends on the state, by the way. Some states require no fault benefits, some don't. So insurance is very regulated by states, just so you know. So some states require this, some don't. Reimburses parties involved in an accident without regard to negligence. Each party is compensated by their own insurance company. Restricts remedies and payments for pain and suffering. And again, state laws vary. So factors that affect premiums for autos. I will tell you that age is a big one. Your gender is a big one. If you are a male under the age of 25, you are paying probably one of the highest rates, just because that age just drives faster and more recklessly. That's just what the actuarial tables and history tells, and so you pay more. So if you are a male under 25 or under, your insurance rates are probably high. So where you live, clearly if you live in a metropolitan area where a lot of vehicles and a lot of people, the chance of an accident may be higher than if you live in a small town. How you use the vehicle. When you buy insurance, they'll ask you, how long is your commute? How many miles do you have to drive to get to your job? That will come into play. So the longer that is, the longer the miles your commute, the more insurance you'll pay. They'll ask you how many miles you expect to drive in a year. Now you're kind of just guessing. They're not holding you to that, but that's what helps them potentially price it. They'll run a credit check on you. The higher your credit rating probably means the more premium you'll pay. Again, your age and your gender, the type of automobile, clearly, right? If a Corvette's going to be more expensive than a small Honda Civic or something like that, and what your driving record is. Do you have a history of accidents and speeding tickets or reckless driving citations or whatever that is? That will all be there. DUIs will definitely wreck how much you pay for insurance. You're going to pay a lot more if you've got a DUI or multiple DUIs. So your premiums are going to go way up. Financial responsibility laws require motorists buy a minimum amount of insurance. I've already mentioned that. Compulsory auto insurance laws require proof of insurance when acquiring license plates. Now, I don't think South Dakota does that. I don't recall ever showing I have insurance to get plates, and our plates we just kind of changed those this past year. But of course, if you are pulled over, you have an accident, law enforcement's involved somehow, then you do have to provide proof of insurance. Many years ago, I was in an accident. It was more than 10 years ago. I rolled over a vehicle on the interstate in Iowa. I walked away fine, uninjured. It rolled 4 times, by the way. And icy conditions is why it happened. And just all of a sudden, bam, I was in the ditch just like that, and I rolled and the whole works. Thankfully, a very, very nice highway patrolman was there within minutes, helped me out. There was no way I could get the proof of insurance out of the glove box. It just wasn't going to happen because the vehicle was that damaged. He still required me to fax it to him, though. He said, I'm going to give you a week to fax that to me. And okay, he really meant business. So you're going to have to show proof of insurance. Supplemental coverage, I've kind of mentioned a few of these. If you want earthquake and flood insurance, you'll have to go through the federal government. If you have a mobile home, RV, boat, jet ski, all those types of things, you'll have to get specific insurance for those. Motorcycle, ATVs, snowmobiles, you'll definitely want to make sure those are covered under some kind of a policy. Most insurance companies will cover those, but you just have to buy extra insurance. It's not normally covered under your auto. And personal liability umbrella, again, just additional coverage for homeowner auto insurance. And quite often higher wealth individuals who are worried about getting sued if they're in an accident, something like that, they probably are more apt to buy that type of coverage because just once you're in an accident, somebody realizes how much you're worth or how much you make, the odds of getting sued go up, so you have to protect yourself. Settling property and liability claims after an accident, be sure to get from the other person, no matter who is at fault. Number one, never admit that you're at fault. Okay, don't ever say it's my fault, my bad. Don't ever say that to the other person. That can be used against you. And when you're in an accident, you're kind of in a state of shock. Even if there's no injuries and even if it wasn't serious, there's still a potential that you're just upset. You're not going to say rational things. So it's best just to stick to the basics. Exchange names, address, phone numbers of drivers and passengers. Get driver's licenses, auto licenses, insurance policy numbers, vehicle descriptions, names, addresses, phone numbers of witnesses. Contact police. Make sure many insurance companies will require that there's some kind, depending on the level of the accident, that there is some kind of a police report filed, and do not leave the scene of an accident. That's, leaving the scene of an accident could potentially be breaking the law. It could be, a hit and run potentially, and you don't want to do that, I promise you. So stay as calm as you possibly can. Wait for authorities if it's serious enough that they need to be involved. But exchange the minimum information. Don't admit to anything. And go from there. Thankfully, I've never been in an accident involving another vehicle. I just rolled my vehicle all by myself. Property and liability insurance agents. Two kinds of agents: captive agents that represent one insurance company. So a State Farm agent would be an example of a captive agent. Independent agents represent multiple companies. They basically have deals with many companies. They're just going to try to find you the best deal based on what you need with the companies that they represent. Before selecting insurance, review the total property and liability exposure that you have, inventory, your exposure, determine the amount of perils that you want covered, the limits, deductibles, and floater policies. I will just tell you that when it comes to insurance, homeowners or automobile, it's almost like a commodity now. That's why you see so many insurance commercials on TV. And I'm sure you can think of almost all the different jingles and pitch names and the whole works. Is because everybody has to have it because it's required. And but just know that it's the internet's your friend when it comes to pricing these things. You can go to a lot of websites by these companies, Geico, Progressive, Nationwide, you name it, Liberty Mutual, State Farm. You can price these policies on their websites without having to provide personal information quite often. If you are looking for an agent to help you with insurance, there's a few routes you can go. Definitely speak to family and friends, parents, aunts, uncles, cousins, siblings, people you trust in your life. Ask them, what do you have for insurance? Who's your carrier? Are you happy with it? Do you have an agent? Is that person, do you trust that person? Can you give me a recommendation? That's always a good place to start. If you need help with insurance, by all means, please ask me. If you need a name of some people to contact for insurance, I'll be very happy to give you names of people that I know are very reputable and will not sell you something you don't need. And they'll ask you good questions and try to figure out what you do need and help you figure that out and sell you exactly what you need and not try to oversell you. So that's important too. So just if you're looking for health or property casualty insurance recommendations, please ask. I'd be more than happy to help you out. Then when there's a claim, claims can be messy. The last claims I had were for hail. We were camping and we had both of our newer vehicles and the camper. And a hailstorm came along and kaplow, and hail damage to all three. And that was the last claim that I had. And it was pretty simple. I just called the insurance company and said, and I kind of waited a couple days just to see what the hail damage was. And sometimes you just set something out in the sun, some of those little dots will pop and they'll go away. So I waited a couple of days on purpose just to see what it would turn out to be. And so I called my company and they sent an adjuster out who looked at it all, and he took pictures and the whole works and said, yeah, there's definitely some damage here. And he goes back to his office and enters a bunch of stuff into some software, and that basically spits out what the claim is. And they deduct what my deductible was. I forget what it was, $1,000 or whatever. And they send you a check, and then it's up to you to get that fixed or not do anything with it. It's just really up to you. So, but depending on the type of claim, that was an easy one to do because it wasn't an accident. If it's an accident, different story, right? Now we need an investigation, we need proof of loss, we might need a police statement or a police report. But the adjusters are who do this stuff, and they will look at the claim, make recommendations about what the settlement should be, or potentially even deny the claim. But anyway, and that's where insurance really, that's when you find out if you have good insurance, is when you need a claim, is when you have a claim. You'll find out if you have a good company. I will tell you guys, I use Liberty Mutual. They've been great to me. I had them for several years. I had State Farm once upon a time also. They were great. With State Farm, you get an agent who's right wherever you live. They're right there. Liberty Mutual is more, I call in a phone number and get help, but they've always been good with me. I use Liberty Mutual because I'm a member of the AICPA, and they just have a really good group discount. So I switched to them several years ago just because it was just a really good deal in terms of price. So, but shop around. Insurance is a commodity. There's many, many, many very legitimate, very big insurance companies that can stand behind their claims and their promises. Quite often it's just a matter of relationships that you developed with your agent or your company, and you go from there. But shop around for insurance. It's okay to switch your insurance if you're not happy with a company. That's very okay. It's not complicated to switch. If you're just not happy with the service or the price you think you're paying, if you think you're paying too much, shop around. There's no requirement. You can't drop one company and go to another. It's up to you. You're the consumer. You make those decisions. So property and casualty insurance is much more competitive than health insurance, by the way, and you really are in control. So I just want you to know that. And if you've got questions, ask your folks, ask people you trust to help you out with it. And I'd be more than happy to help anybody out with any insurance questions if you have them. Thanks.